Welcome to the March 2026 edition of Student of the Market. At THG Retirement Solutions, we break down the noise. We provide a clear monthly snapshot of the markets so that you can stay informed and focus on what matters most to you. What matters most to us is to stay focused on your retirement assets and doing our best to protect and grow your retirement assets. The key themes today that we'll talk about are geopolitical volatility, market leadership is shifting, and the Fed is it on pause? Bonds are starting to do their job. Stay the course amid geopolitical volatility. Markets have historically absorbed political shock better than the headlines suggest. Across major market events, markets were mostly higher 1 year later. And in all of these scenarios on this slide, you will see the S&P 500 was higher 3 years later. Usually by the time you get scared, it's too late to sell. Once again, we'll talk about the Magnificent Seven. None of the Magnificent Seven stocks are outperforming the S&P 500 year to date. You will see that on the far right, year to date 2026, there's a big disparity between the S&P 493 and the Mag 7. Returns within this group are far more dispersed as well in the graph on the right, where you see the dispersion between all of the different Mag 7 stocks. Even though it probably doesn't feel like it, this broader participation is a healthier market signal, as we have known the economy couldn't keep growing on the back of these 7 to 10 companies leading the way. Along with the Mag 7 lagging, you'll see value is outperforming in 2026. Style leadership rotates, often for extended periods of time. So it could be good to look for value, dividends, and free cash flow investments in your retirement portfolio. Bonds are working again. What I mean by that is you will see on this slide from 2022 through 2024, bonds did not act as a diversifier that we are used to. You'll see months when the negative stock market returns happened, also negative bond returns happened. In the last 4 months where stocks have performed negative, you'll see that the bonds have performed in a positive fashion. So hopefully bonds will be a diversifier within a portfolio. While this is very good news, we still like using other non-correlating assets that are truly non-correlating, such as gold and managed futures. Interest rates have remained range-bound. You'll see the 10-year Treasury has stuck in that really 4 to 5% range. It's gotten down in the threes as well, but we think it's very important to be flexible with your bond investing across duration and credit. It's very important compared to just buying a index on the bond side. So pay attention to who is managing your bond portfolio. In closing, we are at a point where we have turmoil, mid-year elections, and a changing stock market leadership. But that is a sign of adjusting, not breaking. I will admit that it isn't always fun. What you did last year might not be the best this year. So diversification remains the foundation of long-term success. As a final takeaway, markets continue to move fast and headlines can be noisy. Staying diversified, understanding the big picture, and keeping a long-term mindset is how you stay ahead. As we continue to settle into 2026, it's always a good time to revisit your risk to make sure that you are appropriately invested. Please reach out to us if you have any questions at all pertaining to how this information meets your portfolio needs specifically or anything else. So we'll talk to you next month. Thank you.